All right, here we go. We are on our second video for week 29 in the finance session. We're going to talk about the balance sheet and the ratios. So the balance sheet is kind of that. It's that form, the sheet that ties your income statement and your statement of cash flows together, and it's where you're going to get a lot of metrics and ratios when you want to dive deeper into your finances. And by dive deeper into your finances, I mean, if you're looking at your debt or your liquidity ratios, if you're looking to get a loan or sell your business, you're going to get a lot of that information from the balance sheet. And the balance sheet is aptly named because it balances your assets versus the liabilities and equity in your business. So the top half is going to show all of your assets, and it's going to be broken down into current and long-term assets. And so current means anything that can be liquidated within a year. So this is generally cash, your inventory, short-term investments, accounts receivable, things like that. It's money that you know that you can get within 12 months is considered a current asset. Long-term asset is going to be anything over a year. Those are going to be stuff like long-term investments, buildings, equipment, that type of stuff. The bottom half, the top part of the bottom half is going to be your liabilities. And these are broken down the same way as the assets. So you've got your current and your long-term liabilities. This is all the money that you owe. So your short-term liabilities would be, if you're doing this a month to month, it could be the payroll that's due that you haven't paid yet. That could be accounts payable. The current portion of a loan that you have. Your long-term liabilities are going to be things like the loans, the business loans that you take out, and that type of stuff. And then the rest of the bottom half of the balance sheet is going to be the equity, and this is what you actually made in the year, what your business made in the year. So this is the money that you have in the bank account, basically. Yes and no, you have it in the bank account, but you've got your retained earnings, your capital stock, all of that stuff that implies ownership of the business is going to be there. Your retained earnings. As you pay yourself a salary, that's going to decrease your net income, which will then decrease your retained your equity section of the balance sheet. If you're taking a draw from the business instead of a salary, again, that's going to come out of your retained earnings. So that's what all of that information is. That's where that's all going to show up, is in your equity section of the balance sheet. It's tricky to know when you're drawing too much or too little based upon the balance sheet. This is a lot of that information you're going to need to get from the statement of cash flows to understand what you can and cannot pull out of your business. Talk to an accountant or a lawyer in terms of what you should be doing in terms of a salary versus draws. And a lot of that has to do with agreements you have with partners and that type of stuff. I've been told, and this could be right or wrong, the best tax situation you can put yourself in is pay yourself a minimal salary. So something that's realistic, but not obviously what you want to make in a year. So let's say like $20,000, $30,000, that's the salary you're making. And then you're just going to draw the rest. And there's some tax benefits to that. An accountant or a lawyer can tell you that better than I can. That's just what I've been told to do. And we're going to briefly talk about ratios. And these are various ways that you can just, again, measure your how successful you are in your business in terms of liquidity or debt or anything like that. A lot of these are going to come from your assets and liabilities and things like that. Back to the whole metrics and measurements thing. If you don't have a benchmark, then it doesn't, like, these aren't very helpful. And that benchmark could be within your business. It could be within your industry as well. You want to know what your industry numbers should be. And you want to be able to explain why yours might not be on par with industry. So if you're better, that's great. If you're worse, it could be for any number of reasons. Again, because that ratio is like a snapshot of your business at that time. So let's say you take out a big loan today because you're going to expand. Tomorrow, if I look at your debt to equity ratio, today after you take out that loan, it's going to be all sorts of it's going to be out of whack because you just took on a huge loan. You just need to be able to explain that away if somebody is looking at that. And again, you're really only going to look at those numbers when you're talking about like selling, bringing on a partner, an investor, et cetera. Lastly, let's talk about debt. Debt is good. It's good. spend somebody else's money when you can spend somebody else's money. A lot of people we talk to are debt adverse, and there's no reason to be if you're taking on a good debt. And that's, business loans and things like that. Getting that toxic debt, that bad debt, you don't want, obviously. So, loans are good. Other stuff like that, like traditional loans are good. Credit cards are less good. So just look into debt and figure out ways that you can finance your business without having to spend your own money. This really depends on your level of risk, but the more credit you can build up for your business, the better it's going to be down the road. And the only way you can do that is by taking some risk in terms of getting some debt. So that's debt with banks, that's getting long terms with vendors, that type of stuff. So as much debt as you can accrue with, without tanking your business or getting under, putting yourself underwater, do it. And if you have any questions about that, there are plenty of experts out there that can help. We can help direct you to some. We've got plenty in our network. So just let us know. That's it on the balance sheet. And we are going to have one more video this week, and that's going to be the statement of cash flows.